Hey there, savvy investors and curious minds. Welcome back to the channel. Ever wondered what it truly means when a stock becomes incredibly hard to borrow, and how that can sometimes ignite an explosive short squeeze? Today, we're diving deep into a fascinating example: Global Interactive Technologies, Inc., ticker symbol GITS. We'll break down exactly why this small cap stock is showing up on our hard to borrow screener and what it could mean for its future. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on GITS, Global Interactive Technologies, Inc. Show company logo/stock chart. This company operates in the communication services sector, specifically within internet content and information, primarily through its subsidiary in South Korea. They're behind Feigning, a digital fan engagement platform designed to support online fan communities. With a market capitalization of just $7.01 million, GITS is a microcap player. Now let's talk about recent price action. Show chart GITS price action. Today, GITS has seen a change of -7.69%. Over the last 5 trading days, it's down -15.42%. However, looking at the last 30 days, GITS is actually up +7.26%. What's truly striking is the volume. Today's volume for GITS was a mere 15,968 shares. Compare that to its 30-day average volume of 1,404,755 shares. This gives us a relative volume of the ARK's average and extremely low volume day. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and what is this cost to borrow we keep hearing about? Imagine you want to short a stock. To do that, you first need to borrow shares from someone who owns them. The cost to borrow, CTB, is an annualized fee that short sellers pay to borrow those shares. Think of it like renting a car. If there are plenty of cars available, the rental fee is low. But if everyone wants the same limited number of cars, that rental fee skyrockets. When a stock's cost to borrow shoots into the triple or even quadruple digits, like with GITS, it tells us a few critical things. Firstly, there's immense demand to short the stock. Secondly, and perhaps more importantly, the supply of shares available to borrow is incredibly scarce. These fees are annualized, meaning if you pay 939.4% CTB, you're paying that percentage of the share's value every year. Daily, this adds up fast, putting continuous pressure on short sellers to either close their positions or keep bleeding cash. Why the stock is hard to borrow right now. Now let's apply this directly to GITS. Our screener flagged GITS because its annualized cost to borrow fee is an astonishing 939.4%. Highlight 939.4%. Yes, you heard that right, almost 1,000%. This number is incredibly high and screams scarcity. Over the last 5 trading days, the CTB momentum has eased slightly by -2 percentage points, but 937.4% is still an astronomical figure. What else makes GITS hard to borrow? Currently, there are only 300 shares available to borrow across major brokers. Highlight 300 shares. For a company with an estimated float of 2.4 million shares, 300 available shares is practically non-existent. This extreme scarcity, combined with the low trading volume we just discussed, creates a very tight situation. Our internal composite squeeze score for GITS currently stands at 47.2 out of 100, indicating a notable level of interest and potential, though not an immediate guarantee of a squeeze. Squeeze mechanics explained. So, what happens when a stock like GITS is this hard to borrow, and the cost to hold a short position becomes exorbitant? This is the fertile ground for what's known as a short squeeze. When short sellers initially borrow shares, they sell them, hoping the price will drop so they can buy them back at a low price and pocket the difference. But if the price starts to rise, or if the cost to borrow gets too high, they face increasing losses and expenses. When borrowable shares disappear, and fees hit nearly 1,000% like with GITS, the pressure on short sellers becomes immense. They are essentially paying an astronomical daily rental fee. To stop the bleeding, they are forced to buy back shares in the open market to cover their short positions. This buying activity creates demand, pushing the stock price even higher. This higher price then puts even more pressure on other short sellers, forcing them to buy back shares, creating a cascading effect of short squeeze. It's a vicious cycle for shorts, and a potential opportunity for longs. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have extremely strong conviction in their bearish thesis and are willing to pay those exorbitant fees to stay short, believing the stock will eventually collapse. Dilution risk check. One major factor that can completely derail a short squeeze, even with astronomical cost to borrow fees, is dilution. Dilution happens when a company issues new shares, effectively increasing the total number of shares outstanding. While this can raise capital for the company, it also spreads the existing value across more shares, typically driving the price per share down. For a short squeeze, dilution can flood the market with new supply, giving short sellers an easy way to cover their positions without impacting the price upwards, or even pushing the price lower. For GITS, we ran a check for recent dilutive SEC filings like -1s, -3s, or 424 BS. The good news here is we found no recent dilutive SEC filings in the last 90 days. We also checked for any recent reverse splits, which can sometimes precede dilutive events, and found none for GITS in our look-back window. This lack of recent dilution removes one significant hurdle that often negates short squeeze potential. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're watching GITS, what should you keep an eye on? 1. Borrower supply. Does the minuscule 300 shares available to borrow continue to shrink, or does it unexpectedly increase? A further decrease would intensify the pressure. 2. Cost to borrow. While 939.4% is already extreme, does it climb even higher, or does it start to significantly fall, indicating less demand to short or more supply becoming available? 3. Volume. GITS's current volume is exceptionally low. A sudden surge in buying volume, especially on positive news or price action, could be a key catalyst. 4. Price action. Watch for GITS to potentially break out of its recent range or move above key resistance levels. 5. Company news. Any significant announcements from Global Interactive Technologies, Inc. regarding its training platform's growth, partnerships, or financial performance could act as a catalyst. Global Interactive Technologies, Inc. GITS presents a textbook example of a stock showing extreme hard-to-borrow characteristics, driven by an astronomical 939.4% cost to borrow and only 300 shares available to short. Its tiny market cap and role in digital fan engagement add a unique flavor to its story. While these metrics signal intense pressure on short sellers and the potential for a squeeze, remember that nothing is guaranteed in the markets. This situation highlights the power of supply and demand, and the mechanics of short selling. We're here to educate, not to advise. Always do your own thorough research. If you found this deep dive into GITS helpful, make sure to like this video, subscribe to the channel for more unique insights, and let us know in the comments what other stocks you'd like us to analyze. Until next time, stay smart, stay informed, and happy trading.